Hello everyone, Aaron Pickard, Chief Investment Officer at Stewardship Capital. And today I wanted to make a video on why I'm cautiously optimistic about the market and that I think it's going to have a better outcome than what most people are hearing out there in the media. You know, if you've turned the TV on, read a newspaper, it's like recession mania out there. And it's come very hard on the news. It's every news item you read, it seems to be that the recession's starting tomorrow. And I'll go over a couple of the obvious reasons why people are having that fear. But first, I wanted to show you what CNN has, this fear and greed index. Shows how people are feeling about the market here. And you can see here that it's at 35 right now. Just a week ago and a month ago, it was sitting at 23 or 25, so right in this area here. And the remarkable thing about this is that if you look at when we've had those types of fear readings in the market at 325 level, it's been during major market bottoms, like at the 2016 level here when we had a big plunge. And then again late last year when we had this 20% plunge from the highs in the market, it created that much fear. Well, we've gotten that in here when the market's really not done a whole lot, down about 5% from these highs. And you can see that this week we had a really nice positive week, maybe signaling again that we've had a major bottom when you look at some of those fear readings. So again, back to the recession mania, it's over two main items, the inverted yield curve and trade wars. I'm not going to go into a whole lot of detail about the inverted yield curve. You've probably read about it, or you could read Google about it. But the main point is that every recession has been preceded by an inverted yield curve, but there have been inverted yield curves that are false signals where a recession doesn't occur. And I'm not going to debate whether it's a real or false signal here, but even if it was a real signal, the recession on average starts 22 months after the signal. And from the signal to the recession, on average, the market is positive. So let's see how this develops. But I think more of the inverted yield curve is different this time. It's more of a global fear over getting a yield from government bonds, and ours are attractive, and so money's flooding here for that reason. Now, on the trade wars, again, I think people are being too pessimistic about this. It has been scary. I support the administration as goals against China. I think it's time for them to grow up and join the world stage in a more fair manner. But the key points here is that we've renegotiated the framework for trade deals with Mexico, Canada, and Japan. All three countries closer to us in proximity. And when you add the combined countries, they dwarf the size of China. We're increasing our imports from Vietnam and South Korea as well. So while it has been a drag on our economy, I don't think it's as big as people think, and it's hurting China far more than it is us. So I think at some point, months, maybe even years down the road, a deal is going to be done. And I hesitate to say this, but I think the escalation of this may have reached a peak, or we won't see a drastic escalation from here. But that remains to be seen. I want to show you what we're watching here. So again, back to this chart, we have this green trend line here that goes from the left to the upper right. You can see here it supported the stock market in 2016, and when it broke here in late last year, we saw quite the plunge below it, and that's in 1 week's time. That was quite the plunge, but it did recover it and hasn't looked back other than a test here in May, and then again here recently in the last month it got close but didn't really touch it. But this is the line that we're watching, that if the market were to go below this level, we would get far more conservative and protect your retirement accounts. But while it's above here, we remain optimistic that new all-time highs will be seen in the future. Now, why can we be optimistic? I think there are plenty of reasons to do so. Corporate earnings have continued to be strong. They haven't been as strong as they were projected, but they're still coming in strong. Growth has slowed, but it's still growth. And with the Federal Reserve is now being more accommodative. They've lowered interest rates. You've probably seen what mortgage rates have done. They're incredibly low. And if you look at the housing index is making new highs, and that creates a lot of jobs and will help turn the sentiment from that fear to more comfort and eventually maybe to that greed level. So we think that outcomes are going to be far better than people have feared from watching the media. So stay tuned. We will update you in the future if anything major changes, if we were to cross below that line. But until then, I think we can be cautiously optimistic. Until next time, take care.